Hey, what's up? I'm Russ. So, Amazon just announced that they are doing two of the three things that we're going to talk about in this video, which is a stock split and share buybacks or repurchases. That's given me the motivation to do this video, especially for beginner investors. Most retail investors usually know what these things are, but if you don't, it's okay. Sit back, relax for a few minutes while we touch upon what a stock split is. Amazon did announce a 20-for-1 stock split where they are also going to be buying back $10 billion worth of shares. Now, we've seen companies recently split their stock as well as Apple, Johnson & Johnson, and Tesla. So why would a company want to split their stock? The simplest way I can explain it is they are really successful. Very successful companies keep going up in price. Why? Because we want to own success. They are very profitable. But the problem can be that their share price can get really, really inflated, as is the case with Amazon, where at the time of the recording of this video, they're pushing almost $3,000 per share. So using that number, what Amazon is going to do is the equivalent of taking a $20 bill from you and giving you 20 $1 bills. That's all that it is. The market cap doesn't change. The value of the company, in other words, does not change one bit. What this will do, we divide $3,000 by 20, and that would give us about $150 a share. So instead of one $3,000 share, you would have 20 shares, each worth $150, which is $3,000. So it's kind of a little magic trick sleight of hand that they're doing. And what that does is people the day before will see that Amazon was at $3,000 a share. And then the next day, holy crap, what happened? It's at $150 a share. I got to buy up on that. Look how cheap it is. But now you know that Amazon is not any cheaper than it was the day before. They have just done a stock split. Keep in mind, if you were to have any fractional shares, so if the split would leave you with 14 and a half shares, you will only receive the 14 shares and you will be paid cash for that half a share. Now, we like stock splits, but what you have to be aware of is a reverse stock split. Stock splits are something that successful, profitable companies usually do, and companies that are in trouble usually resort to a reverse stock split. Now, we recently saw this with Aurora Cannabis, ticker ACB, when they did a 12-for-1 reverse stock split. All that they did was kind of the opposite of Amazon. For every 12 shares you held, because I was one of those, they gave you 1 share. And they did this because they were in danger of being delisted from the exchange. You have to have a minimum requirement, and they were below the $1 threshold. So, because now there are less shares out there, it pushed the price of that share higher. But the same as a stock split, their company's value did not change. They're still the same bad company after the reverse stock split. Thinking again about profitable companies, there are 3 basic options that companies can utilize to return additional value to shareholders. The first thing that a company could do is to reinvest their retained earnings into the company. And this is what a lot of the growth companies do, that they're trying to expand their business and they're trying to grow. And what you could spend your money on, what they could spend their money on, are research and development, new equipment, retrofitting and upgrading old equipment, additional labor, or additional marketing to help try and expand and grow the business. Second is dividends. Now remember, dividends are not guaranteed. They can go away at any time, but companies would usually be punished by shareholders by selling the stock if they cut a dividend, so they try to avoid it. It's pretty close to a guarantee. You usually see this from big, stable, mature companies that don't have a lot of growth expectations, and we're buying it for the cash flow. And they're really more stable, less risky companies. Like one that I invest in is Duke Energy, ticker DUK. They are a utility company, and it's really tough for them to try and expand into a new city, into a new market, because they're a regulated utility, which is good and bad, but mostly good because it means that they have a constant supply of customers. They have a pool of customers to draw from, and they don't really need to do that much research and development or marketing. So they're always going to be paying a nice and steady dividend. The third way is share buybacks. Now, share buybacks are really interesting because they are removing shares from the available supply for everyone to buy. So because there's less shares out there, it means that it increases the earnings per share, the return on assets, and the return on equity are a few of those things that get boosted because there's less shares to spread the profits out over. So that makes the remaining shares more valuable and helps to return value to shareholders that way. This is what Warren Buffett loves. He loves to buy back shares, especially when the company is where he believes to be undervalued, which also signals to the market that the company believes that their shares are undervalued, and people usually start buying. This happened with Amazon as soon as they announced a share buyback. Warren Buffett doesn't like dividends, particularly from the companies he owns, because he feels it's inefficient tax-wise, that it's double taxation, right? Because first, the government taxes the profits that the company makes, and then when we receive the dividends, we have to pay taxes on those dividends. So when we have a company buying back shares, we don't have to realize those gains for many years, only when we sell. If they're not in a tax-advantaged account like a Roth IRA, at the time of the sale, then we will pay taxes on those gains, and not every time we receive dividends. Warren Buffett would just rather invest into growing the businesses. And also, the cash spent on the buybacks is an asset which is deducted from the balance sheet. But there are a few things that you should also just keep in mind and just be aware of that companies could be doing with share buybacks, like hiding the fact that a large number of stock options are being exercised, or borrowing money to do the buybacks. Unless it increases cash flows, then that is debt that is well spent. Plus, the interest paid on that debt is tax deductible. And speaking of Warren Buffett, we've been going through one by one the shareholder letters that he's written, going all the way back to the 1950s, which will eventually culminate with the most recent one. So if you'd like to hear some wise words of wisdom from Warren Buffett, click this little box next to my head and I will talk to you there.